Hey everybody, David Screek. I'm going to get right into it today. So it looks like, I've been calling for some kind of obviously 1929.87 to not happen because we're having this big smash here in the summer. And I think, look, you always have to be flexible. I was looking for some kind of drawdown in the markets. I really don't know now if this is the start of a big bear market short term. And the reason being is, I'm going to show you this, is quite simply the VIX. When the VIX has a huge spike like it does today, which we're going to show you, um, but when it has a big spike like this, you're going to probably see a large rally. The Fed is almost surely now, I just saw there's 100 basis points worth of rate cuts now worked in by November. So that's gone from just a few months ago, there was 25 basis points, maybe, at the top of the market just a month ago. And now, we have this. So I'm going to show you why this is happening, what to do here. So for my paying members, just, I'm going to do the video for paying members right after this, and we're going to have some recommendations, what to do, etc. And I really believe shorter term, we're nearing a low. And so let's get right into it. I think one of the big reasons this has happened is because of this chart right here. The Japanese yen. Okay. And you can see we're now at basically back to where we were at the beginning of the year. This whole decline, which took, 6 and months and a bit, has been basically wiped out in a month. So, and we've seen that, the yen rally hard. And there's this trade on, there's a carry trade on where people borrow in yen because yen still, Japan still has the cheapest interest rates in the world, even though they've gone up. And then they speculate all over the world. So usually if you go back, and we'll show you a longer term chart to prove this, if you go back, we're going to go back 25 years here. If you go back 25 years, what you'll see is during all these times where markets went low, here's 2007, 2008, or in global liquidity tightens, the yen tends to fall. 2015, 2016 was a time of a big correction. You can see the end of the bear market in 2002, because again, people use the yen, they borrow in yen, they speculate around the world, and then when they kind of get out of that trade, you can see the little spike that happened here in 2020. They have to basically sell their risk assets and then buy back their yen to pay back that loan. So imagine you were borrowing yen at 0.5% here. Well, now the yen is 10% higher, say roughly, and stocks are down 10, 15, 20%. So you've lost money on the speculation of stocks, and you've lost money, basically you're borrowing the yen back. This looks like kind of a short covering rally. And I think this is one of the main reasons. No one's really talking about it. They're talking about the US economy slowing, which it is, potential recession, which could happen. But I really think this is the big deal now. What's interesting about it is, usually we see the US dollar rally kind of in these times of, but now we're seeing a drop. And I think part of the reason we're seeing a drop is now that these interest rate cuts look like they're going to be more aggressive than people thought. So, Europe has started to cut rates, UK has started to cut rates, Canada started to cut rates. So now the US is basically going to start to follow suit. Let's get a shorter term chart so we can really see the US dollar here. And you can see now, like, this is kind of a breakdown of the support, and we're at the 200-day moving average. The last time we hit the 200-day moving average was at the end of last year, and it bounced off and rallied. So, but I think this is probably more the sign of a top. And then, of course, we've seen other things happen here, like the TLT is rallying hard. Interest rate, I talked about it the other day where it looked like it could break out. Now, today, again, kind of looks like a day where potentially the market is bottoming, and then the TLT may be seeing a short-term top, and the Fed is now way behind the curve, by the way. The Fed is, we've seen this now. That look at this. These rates are under 380, 377 on the 10-year bond, and they still have the short-term rates at whatever at 525 to 550. So we'll quickly look at those short-term rates. So this is these meetings. You can see how it's changed now. Now there's a 95% chance of a 0.5 point cut in September. There's a 65% chance of another 0.5 point cut, and basically almost 100% that there'll be 75 basis points cut by November. December is now, you can see 70% of 125 basis points and 18% of 150. So we can see how this has changed. And let's go out a year. So a year from now would be basically July 30th. And you can see, now there's basically a 75% chance that the Fed funds rate will be 200 basis points lower than it is today, a year out. So that is a huge change. And I've said that all along. I said, look, if you look at rates went from 0 to say, let's say 550, you could easily go to 275 because that would be a 50% retracement before the next wave higher. So we're kind of in one of these cyclical counter moves. So for those of you who don't know the terms, a secular move is a long-term move that's 10 or 20 years in length. And a cyclical move is something that's 1 or 2 years in length. So that's essentially what's going on in these things right now. 1 or 2 years or 10 or 20 years, 20, these 10 or 20 years long cycles, sometimes 30 years or even 40 years in case of bonds. The last bond bull market was from the early 80s to 2020. It was almost 40 years. And then you can have these 1-2 year moves, which are counter moves. So right now we're in a counter move. I think long-term interest rates are going to continue higher as we enter probably this sovereign debt crisis sometime over the next 5 to 10 years. But in the short term, meaning the next year or two, we're probably going to continue to move lower in interest rates. So let's look at, of course, the thing that everyone's looking at right now, which is stocks. Let's actually start with the VIX. So when we look at the VIX here, we're looking at, this is the weekly view. You can see we come off to 36, but this was a gigantic panic today. This really was a panic. I'm going to get a long-term 25-year chart to show you this. So what we can see is the only other 2 times the VIX got nearly as high as it were today on the intraday basis was 2008, which is, of course, the financial crisis. And then the VIX slowly came down. Now, doesn't have to mean it's going to predict the exact bottom. The VIX actually was 50 in the March of 2009, which was the bottom, and 85 here. And the market was about 15% lower here. So, but if you had bought any time in this range, you did well. And then you can see the spike here in 2011, in the summer of 2010. These ended up just being short-term corrections in the market. The spike here in 2015 kind of reminds me of the day in 2015, actually, to be honest, to be very blunt. You can see the spike here. That was February. Now, of course, in February, this is what maybe a similarity now is that in February 2015, when we had this spike, the market essentially had a very short-term sell-off, then rallied slowly back into early October. So really rallied for 6-7 months, and then began to roll over and enter a bear market. So maybe that's what will happen now. Maybe what we'll see is a rally into kind of the end of the year, the Fed loosens, et cetera, and then we see this kind of move lower. And then you can see here 2020 ended up being, but you can see on this intraday move here, we're the only other 2 times were 2020 and 2008. And of course, over the next year or two, those ended up being major lows for the market and major moves higher. You can see we're even higher than we were during the 22-23 bear market. I'm going to go back 30 years so you can see 1998. And you can see this spike up here. I remember the fear in 1998 and the VIX there. Now, it went over to 50 at the time, but they changed the way the VIX was calculated. So the VIX is calculated, it's lower now. I don't want to get into all the details behind that. But if you look at all these VIX moves, when the market goes, the VIX goes to about 40 or over 40 intraday, those are usually pretty significant lows for the market. So we're going to look at this right now. And like I said, I think even though the economy is weakening, it has more to do with this yen trade. So now we got to watch out. Are their hedge funds going to blow up because of this yen trade? That's something to very look at here. So, and what I want to look at here now, we're going to go back to 1998 because I want to look at these summer lows in the market, these August sell-offs. So 98, there's a VIX. So we're going to go look at the S&P. And there's the smackdown. And you can see some kind of similar. And actually, it happened. We're going to go back to July so we can really see what happened in 1998. And you can see it actually topped here. There was a smackdown, a consolidation. So is it like this? Because that was early April. Do we see early August? Do we see another smackdown to the end of this month? I don't know, because right then the S&P fell 10% and then it fell about 20% when that was all said and done. And we look at the VIX, but here's the difference: is you can see in that first smackdown in August, the VIX was just over 30. then it kind of went sideways, and then it had to move back. Now the VIX is right here. It's right where it was during that period. But also, too, what you have to note is when you have these big declines like this, you usually don't just see a V type bottom. You can see 1998, there was a rally and then a retest of the lows and then off to the races as the Federal Reserve cut rates. So let's go look at 2011. Actually, we'll look at 2008. And the reason I want to look at 2008 is even though it wasn't the low for the market, there was a similar sell-off that August as well. So you can see in, oh, sorry, 2007. I apologize for that. So I was thinking about the 2008 crash. So we're going to go to 2007. And you can see this kind of move lower here. And it was a big smackdown. The S&P fell about 15%. We're going to go look at the VIX coinciding with that. You can see the VIX spiked, not as high as it today, but it went to almost 40 intraday. And that led to a pretty good rally, and the market went back to its highs. And if you go look at 2000, I'm not going to look at 2000 right now, but 2000 had that kind of move down in April of 2000. And then the market moved back to near its highs in August before starting the bear market. So maybe we see something like this as well. And by the way, I was only going to do a video like this for paying members, but I think now that we're seeing this action, and now that I actually have some specific stock recommendations for my paying members, because we're finally seeing a tank, I just wanted to show these right now. So that's the VIX right now. This is the S&P right now. So we're going to go look at 2011. And what we're going to see is the same kind of thing. You can see this, the market actually peaked in August. You see this big smackdown in August. You can see how short actually it did go to a slightly lower low in October. Oh no, sorry, this is the VIX. Sorry, the VIX. We can see the spike up in the VIX. And same thing was kind of like early August, like now in 2011. And the same thing, it took to about October for the market to kind of bottom, and then we rallied. The VIX fell the rest of the year, but same thing. The VIX went to almost 50 intraday. It was in the teens in early July, just like now. And then for whatever reason, we do see these in the summer. So now we're going to look at the S&P during that same period. Here you can see the S&P went from 1360 down to almost 1100. This was nearly a 20% drop in the markets, actually. And then you can see there was backing and filling for months before, after October, the market started to take off. So you can argue maybe there's not a huge amount, a huge amount of, I guess, like, you don't have to be in a huge hurry to buy the market right now. So, but like we can see these kind of things that happen. Let's go look at the 2010 summer sell-off. And you can see the same thing here. This is the S&P. You can see it was 1120. It smacked down here to about 1030. This wasn't as huge as a correction, and then began higher in 2010. If we go look at the VIX, we'll see the same kind of thing. The VIX moved higher. Actually, that correction happened more in the spring, actually. So we're going to go back to. You can see the VIX again spiked here and this sell-off in May. And then if we go look at the S&P, you'll see that the S&P took a few months to, again, bottom. You can see right here, the S&P began to sell off in May, June, and then actually bottomed in early July, retested in August. So you can see these things usually take a few months to do. So now if we're going to go look at the summer sell-off of 2015. Summer of 2015, I was so bearish on the markets. I thought the markets were going to crash in 2015. Sorry about that. So 2015, and you can see, boom, this is similar to, I think this is probably the most similar to what we're seeing today. So we can see the 2015, you can see this huge boom, 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 boom sell-off. The VIX spiked. Then we had this rally into like mid-September, and then to late September. This all took about a month, and then the market began to rally into the rest of the year. And then actually there was another sell-off in January of 2016, which kind of went back to these lows, and then the market took off. So these things can take months and months to play out, but buying the volatility low usually works. This is and again, you can see same thing, this intraday spike in the VIX to over 50. And then you can see at those retests in like October, etc., the VIX was nowhere near as high. So I would expect something like that to kind of happen here. And then let's go back to 2018. You'll see what I'm talking about. Now, this could be a different scenario. What happens if the market doesn't bottom right now, right? What happens if the market, kind of moves lower ultimately? And this is kind of what happened in 2018, where you see that big spike in the VIX here, the market sold off, then the VIX slowly came down, and the market actually topped here in October and then fell into the remainder of the year. And we're going to see that now when I show you the S&P. You can see this smash in the S&P from nearly over 2,900 down to about 2,600. So similar to now, like just over about a 10% correction. This rally here, it's moved lower. Again, another retest in April. We can see a lot of these times, a month or two later, there is a retest. And then the market slowly moved higher and actually went to a new high in September, October before really selling off that fall. But notice that fall in winter, the market hit a new low. It broke that low. I think we could be in something like that, where we're seeing this volatility spike now. We could see, because the Fed is going to come to the rescue. They're going to try to prop everything up into the election. We could see a few months of strength, and then we could see the market really maybe roll over something in the new year. I don't know. No one has a crystal ball, but these are just scenarios, right? So this is 2020. So in 2020, you're going to see the VIX spike when they shut everything down during COVID, right? And you see the move down here in the market. The market essentially had a mini crash. The S&P fell from 3,400 to 2,200, actually fell over 30%. Remember, they had shut down the entire economy. We're obviously not seeing something like that now. And then the VIX, you can see, again, this huge spike. You can see it spiked to about 50, 60 here, and the market still kept falling and went to 80. Now, 80 is an extreme case. 80 is where it went in 2008, 2009, and 2020. But when you get into this 50, 60 range in the VIX on the intraday, usually you're going to see some kind of bottom and rallying on the markets. And I combine that with, like, the Federal Reserve is now way behind, obviously. Like, they need to cut rates, and, I'm someone who's worried about inflation, worried about the long-term bond market, blah, blah, blah. But in the short term, you just have to look what the market is telling you. And if the Fed had half a brain, and I really don't think they do, yeah, they need to cut rates here, So you can't have the 10-year bond, at 370 and the Fed funds rate at 525. That makes no sense whatsoever. So this has been a while in the making, as they would say. So I figured I'd show you all this. So for paying members, watch out. I'm going to have a video. I'm going to talk about a few stocks I like. Some of the stocks, one of them I sold a bit of. I'm going to maybe get back into it. Two of them are two very beaten up new recommendations. We're going to go over some of our stocks. One of them is a company that's reporting earnings tomorrow. Well, I can mention that company because, I talked about it, my favorite stock. So, I talked about Fubo as one of my favorite companies. That's 2020. And you can see where Fubo came from, by the way. Don't worry, I had no interest in it back then. So I want to show you Fubo, and it's only down 5 cents now today. This is about the area where I bought it. My $1.25 to $1.30 is about my average price. So it's gotten waxed by this, and the reporting earnings tomorrow, plus their antitrust lawsuit also begins on a Wednesday. So I really like Fubo, and yeah, I really, really like this, and I really like this, going forward, so what we're going to see if the earnings come in, it may be good timing in terms of, I know that this sell-off has caused the stock to whack from near 150 to, 130, but maybe now it's going to report earnings, have potentially a bunch of good news while the market kind of bottoms and moves higher in the coming months. So I'm going to leave it at that. Obviously, I own Fubo. I own calls on Fubo. So everybody take care, and I hope you're all doing well.